Welcome back to For the Record. I'm Jed Donahue. Our guest, Paul Nichols of Financial Abundance in the in-state college. They're an independent registered investment advisory firm, and we spent segment one, as you know, talking about the economy and the state of the economy. Let's move into your business a little bit. And what do you see are some of the biggest issues in the financial services industry right now? Let's talk about home for a minute.
Yeah, I see some forced disclosure regulations being forced upon the financial services industry. I've said it for years.
Forced disclosure would
Well,
be...
what I mean by this is industries that don't police themselves will be policed.
Gotcha.
And there is a blatant disconnect, in my opinion, in this industry as it relates to disclosure. You can simply look at your statement and realize there ain't none. Okay?
Right.
I mean, seriously, how many people can look at their statement and really ascertain what's going on? And which is really always been amazing to me, Jed, because it could be transparent. So I guess there's two really areas I believe that have to be done, and we're certainly heading in that direction. Number one is forced disclosure. Total 100% forced disclosure. Now that's happened in the 401k arena. New laws will be instituted and put into effect this year that are going to force disclosure. It should be done more in the individual arena as well. I call most investing retail investing, in my opinion. So disclosure would be one area. The other one would be forcing advisors. See, there's two types of advisors out there. There's registered representatives and there's registered investment advisors. They're held by different standards. A registered investment advisor, which is what most people have, okay, works for a large brokerage firm or a bank, are held to what's called a suitability standard, which means they need to fill out a form that says it's suitable based on age, income, etc. Where a registered investment advisor cannot use a suitability standard, they have to use a fiduciary standard, which says they have to act in the best interest of the client, suitable or otherwise.
I gotcha.
So what I'm hoping is going to happen, there's only about 5% of the industry's registered investment advisors. I'm hoping that the industry forces more reps to have to get the registered investment advisor designation to force the fiduciary standard rather than suitability.
Next question. You know, how does one get educated, not overloaded about the industry, and then they're insured about making prudent and wise decisions financially and things along those lines? There's a lot to think about, not only with your money, but going in and trusting an advisor.
Well, let's talk about
with
that.
My future.
Yeah, let's avoid that. Let's get rid of that. I'm going to be, and have been, a proponent of dropping that whole idea. In fact, I go to mastermind groups in California with advisors from around the country that have large independent practices. And one of the things that came up in a recent one was a conversation about trust and building relationships. And I had to hold some feet to the fire as it relates to that because, in my opinion, it's not about trust, it's about competency. I've had more people in my life that I trusted, family, take advantage of me than anyone else. And here's the challenge. Until you understand what's going to go on, you're going to have to trust somebody. So if you want to go that route, that's fine. Now, to say that I have to trust because I'm not educated is one thing. But to say, hey, I have the ability to get educated and I can decide whether I want to trust or not. So without sounding too complex, I say quit trusting and start understanding the few key things you need to know. And it's not that many things, Jed, really, to understand how to prudently invest. But most of the techniques out there are simply nothing short of speculation and gambling techniques that elicit trading. And trading is where the industry makes their money.
Right. I mean,
does that answer that question?
I think it does. I mean, I think there's a follow-up that, you know, you mentioned, and it does dovetail in to education is a big part of what you
That's my stick, if you will.
Well, that's one of who you are. I mean,
Yeah.
it's in your position statement with Financial Abundance. So you try and help the client. You've got to educate a little bit.
Here's the thing.
I mean, I'm not going to the racetrack and I'm not doing a 2-5-6 here.
Right.
With
Here's what I tell
future.
people. I agree. Here's what I say to people. If you want to work with me, it's going to require doing some homework. Okay. You're not going to hear sales stuff from me. If you don't do the homework, then we're going to have some issues. Because you have no right to call me up as a client, Jed, and say, hey, Paul, blah, blah, blah about the market if you haven't been to training or haven't done some of the stuff that you need to do. Part of it is taking responsibility as a client. Clients need to take responsibility and get educated and not just rely on what their advisors tell them. And the fact of the matter is, most advisors are commissioned salespeople. I don't care If it says registered representative or anything on that card says securities offered through, it's nothing more than a glorified sales position. Okay, so, and I'm not knocking, most guys and gals out there are great people, they're doing the best they can for their clients. But when you're part of a mechanism that's dictating to you what to do and how to do it, you're nothing but a glorified salesperson. You're not someone that's saying, hey, I don't agree with that, you should do this, and here's why.
So you're telling me the difference between you and maybe some others out there,
The majority.
and I mean, just talking philosophy here, whether it's fair or foul, is that you want your clients to be educated coming through the door.
I don't want them to trust me. I want them to know, because I don't want to field dealing with clients that don't understand later. I don't have clients calling me up in 2008 freaking out about the market. None of them got out of the market. Why? Because they've been trained not to listen to the investment pornography and the hype that's propagated from most media sources.
Yeah.
That's Paul's opinion, okay? It's not everything you read out there, every magazine you read is point counterpoint, Jed. You can't pick up an investment magazine and not find point counterpoint in it. You cannot watch a TV show on finances that doesn't talk point counterpoint.
Right.
As a result, any show or any magazine can go back 6 months later and say, see, we told you so. Well, of course, you're in the middle on everything. So, you know, it's too late when you read about it. Is my point, and most of it out there is just hype. It's designed to create a reaction.
Right.
Fearfully or greed-wise.
60 seconds or less. I mean, sometimes is, you know, do I stay or do I go? You know, that particular statement right there about, you know, I feel uncomfortable what's going on. You know, let's use oil speculation as one example, you know, energy stocks or something along those lines. I want out. What do you know?
Well, do you know anybody that's at peace with their investments?
No, not
Why?
really.
Why?
I don't know.
Makes you wonder a little bit. Okay?
It does.
I believe it's a lack. It works. Education leads to clarity, and clarity leads to confidence, and confidence leads to peace of mind. So most people don't have peace of mind because everything they hear is point counterpoint. It's nothing but, back to my earlier point, it's nothing but hype. Same with speculation, gold. Let's use gold as an example. Oil, gold, grain, whatever it is. It's a commodity. It's generally pitched as an inflation hedge, okay? But it's kind of like gold. Why is gold $1,200 an ounce right now?
Right.
Because the fear-mongering that's gone on the last 2 years has driven it up. Now, is gold a good investment? Well, I think if you have a well-diversified portfolio, you're going to own gold already, won't you, in the portfolio? But to think that it's a good investment, I guess, back to the oil question, well, if you're good at calling bubbles.
Right.
If you're a good bubble timer, then oil would be good, or gold would be good, or real estate would be good.
All right. We're with Paul Nichols, Financial Abundance. We'll find out about financial abundance and some other topics related to the economy and in the investment world with more on For the Record.